Hello there. Thank you so much for joining us today. I'm Marche Butler, the webinar director at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and, however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation, and here are a little bit of instructions for you. Attendees are muted, but we do encourage you to ask questions using the chat box. Let me go ahead and make sure that it's turned on. Just a second. All right, there we go. So the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to our question during this event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Josh Carter is our speaker today, and since starting his practice about a decade ago with Northwestern Mutual Wealth Management Company, Josh specialized in working with people in the red zone of retirement to define, build, and enjoy prosperous lives in retirement. Josh's commitment to planning first mentality gives his clients confidence when developing a plan to turn assets into income. Josh is a graduate of Florida State University with a double major in finance and business management and a minor in Arabic. Josh is a certified financial planner, chartered financial consultant, and retirement income certified professional, holding FINRA Series 7 and 66 to 15 life, health, annuity, and long-term care licenses, serving clients in 19 states and every U.S. time zone. Please welcome Josh Carter.
Hello, thank you guys for having me. There are three core areas that we work in. Marcia, you mentioned the retirement one there. The other one is with medical professionals. So this is what our third or fourth, I think, webinar that we've done. So maybe needed to update the introduction there. But well, I'm happy to be here. Again, I help specialized physicians define, build, and enjoy prosperous lives. Today, we're going to show you 3 ways to thrive throughout your career, because there are some very distinct phases for people in the medical field. So I'll show you how to not only manage, but win the student loan game, how to protect your balance sheet and earnings capacity, no matter what curveballs life throws at you, and how to invest in a tax-efficient way, some high-level ideas on that end. Most people in the general public think that those in the medical field are all set financially. As soon as you get out of residency, you're just ready to go, making the big bucks. But that's not. It's not always as simple as that. So, but what they don't realize again is that you face unique challenges that can really complicate your financial life. Those challenges actually make financial planning a lot more important because of liability exposure, having a target on your back because of the assumed income that you're making. So let's start getting into some of the initial challenges here. So unique to people in the medical field, first, your schooling is very expensive. I think you already are aware of that. You'll probably graduate with a lot more student loan debt than the average person. And we've crossed what I think $1.5 trillion in total student loans at this point as a country. So You guys make up a good portion of that. The second is because of the amount of education and training, residency, fellowship that you need before even entering into your full-time career, you usually don't start earning a real meaningful paycheck until years into your career compared to a white-collar professional like me. Finally, your jobs are very intense, to say the least. A couple stories that I've heard from ER doctors that I've worked with over the years will make some people's skin crawl. But this means that you don't really have a lot of free time to devote to your own personal financial plan. It really is strategically important to bring in the specialist so that you can focus on work and the ever-changing knowledge base that you need to be accustomed to. And then when not doing that, focus on your family and a personal life. So we'll spend time today on how to best manage your financial reality so that we can get past these hurdles, take control of your finances, and also prepare for a secure future. So because everything stems from how much money you have to work with, we'll start with a quick discussion on budgeting. Actually, really, budgeting is like a curse word in financial planning. I like to say spending plan. Everybody likes to spend money. Nobody likes to budget it. So a good rule of thumb that I teach the residents that I work with and give presentations to is the idea of the 60-20-20 rule. And what this means is that, whoops, a little too early there. It's 20% of our gross income we want to be setting aside for saving and investing. This is paying your future self, again, because you have a delayed earnings peak. Because most people in the medical field, you get out of a fellowship in your mid-30s, comparing to somebody getting out when they're 22 and saving money. If you lose a decade, we'll talk about this later in the talk here. The compounding effect of growing your money you're not able to take full effect when you're in medical school if you're not saving then. So we really need to focus on saving and accelerating that the first couple of years into your career. The 60%, that would be essential expenses. That's going to be your housing, your transportation, your money for the kids and paying your student loan payments, those types of things. The other 20%, that's going to be the funny money, as I call it. This is going to be the Porsche as opposed to the Prius. This is going to be the country club membership. This is going to be the traveling, the dining out, all of the fun stuff in life. This probably seems pointless I guess it might seem pointless to get in a habit of budgeting when you're in residency, for example, because your income is going to drastically change, just in a couple of years, finally. But the hardest part of financial planning is getting the habit of saving, getting the habit of reducing our current consumption. 90% of financial planning is really about actionable habits. So a basic written financial or basic written budget or spending plan will help you get to thinking strategically about your money by creating a purpose for every dollar. And by the way, employer matches on your 403b, 401k, that counts towards this 20% sliver here. But knowing what's coming in, what's going out, where we can trim some fat, that's going to help us make meaningful progress towards each of your financial goals, whether it's retirement, saving up money for your kids' schooling, whatever else is most important, future house on the river, that kind of thing. But the reason this is important on the front end is because as you transition out of your training and into your full-time practice, having those habits in place creates a very strong backbone for increasing your lifestyle and scaling your life financially after you're out of all the 8 billion years of training that you guys have to go through. So But as I was talking about budgeting, one of the main things that a chunk of your monthly expenditures is going to be going to is student loans, obviously. If you were thinking about that as I was describing it, that's for good reason. Medical school is very expensive, and student loans is a major concern for most medical professionals. I don't need to ask you what most people leave medical school with in indebtedness, but $200,000 is the answer here. That's a ton of money. It's a mortgage for some people. And again, that's not even the high end of the scale. That's the middle ground answer. So I'm guessing that some people on this call are somewhere in that neighborhood, but the prospect of paying this off can definitely feel overwhelming, but you have options in terms of how you repay your student loans. The key is to choose the repayment plan that fits your personal needs. So let's go through a couple of the options here at a high level. Repayment plans can be broken down into two major types: traditional and income-driven. Traditional repayment plans look at how much debt is owed over a certain time period. It's very much so like a regular amortized loan. Every month you pay the same amount towards the loan principal. With an income-driven repayment plans, your monthly payments are calculated as a percentage of discretionary income. You could pay less now, say when you're in residency, and then more later as your income grows. These usually have a 20 to 25 year runway as far as how long they can be paid for. And then after that, the remaining balance is forgiven. On a lot of plans, though, what's forgiven is counted as taxable income, though. A lot of people don't factor that in. If you have $200,000 that's forgiven 20 years from now, when you're making $500,000, all of a sudden, you're in a $700,000 taxable income bracket for that year. So a lot of people are surprised by the tax that comes around when that comes into being forgiven. So let's talk a little bit more about the traditional repayment options here for a moment. These plans are, again, very simple because they consider only two factors: the amount of debt that you owe and then how long over it's going to be, the time period that's going to be repaid. Your monthly payments, again, stay the same for the duration of the loan. They could gradually increase based on a couple different factors, but these traditional loan repayments plans can, again, extend up to 25 years. I would hate to see you burdened with debt for that long. Would generally like to pay that off a little bit quicker, because the sooner that we have those dollars freed up, the sooner that we can be putting it towards other financial goals. But the longer the term repayment, the more you'll end up, again, paying in interest. So rather that money staying in your pocket than in the banks or Uncle Sam's or whatever else it might be. So on the income repayment side, tends to be extremely popular in the medical field because when you graduate, money can be very tight. The lower payments of these options in the beginning, again, can be extremely helpful as you scale your practice and get into your full-time career. As your salary increases down the line and you have more financial breathing room, your payments will increase at that point. So there are 4 income-based repayment programs out there. The first is the income-based repayment plan, or just basically IBR. Under this plan, you pay 10% of discretionary income if you became a new borrower after July 1 of 2014. If you borrow before that date, it's 15% of discretionary income. You'll never have to pay more than a 10-year standardized repayment plan amount, though. So it's a set time frame. Next, you've got the pay plan, pay as you earn repayment plan. Under this one, again, 10% of discretionary income. And again, never more than the 10-year standardized amount. To be eligible for this one, you can't, what's the way to say it? You cannot have received a federal student loan prior to October 1 of 2007 and must have received a disbursement of the loan on or after October 1 of 2011. Maybe a small sliver of people fit into that category. These are some income guidelines, there are some income guidelines that apply to these two plans, but essentially you have to prove a partial financial hardship to qualify for either of those. The next two would be the revised pay as you earn. Under this one, again, 10% of discretionary income rule applies. This plan has fewer requirements than the other two. It doesn't matter when you became a borrower, and when it comes to the government paying some of the interest of your loans, this has been a better interest subsidy than other situations out there. The last one is the ICR, the income contingent repayment plan. Under this plan, the payments are limited to the lesser of either 20% of discretionary income or payments that are based on a 12-year adjusted amortized schedule. So neither of these last two plans require you to prove financial hardship. All that to say, though, where do we go from here? Another factor to consider when thinking about paying back the loans is the possibility of the public service loan forgiveness. I recommend everybody try to qualify for this, and this can sometimes be combined with an income-driven repayment plan also. But what this means is that if you work for a public service and you meet certain criteria, you can be eligible to have your loan balance forgiven. I was telling Marche that I am leaving for Europe for 2 weeks tomorrow, and which is also why I'm a little scruffy right now. I have this stupid tradition of growing out my facial hair before and during being in Europe, but mine's been crazy this week. So, but there's two qualifications for this. You must have to work for, you have to work for a qualifying entity, such as a governmental organization or a nonprofit. And again, for context, 75% of US hospitals are nonprofit or public entities. Second criteria is that you have to make 10 years of student loan repayments under this qualifying repayment plan. After those 120 monthly payments, and if they're on time, the balance will be forgiven. The benefit of this compared to the other forgiveness options is that if you work for a public entity like this, the amount that's forgiven is not taxable income. It's not counted as taxable income for you. So again, making $500,000 after those 10 years, $200,000 forgiven, it's just wiped clean. You don't have to pay, you're not bumped into that $700,000 of household income, no surprise tax bill. So huge benefit, as you can imagine here. So, but the bottom line is that there's a lot of factors to consider when choosing your repayment plan. But I always recommend to at least consider the public loan option if you can qualify for it, because for the teaching hospital here in Jacksonville, Florida, the residents that I work with there, they've got 4 years of residency. If they just do another 6 years in their full-time career, maybe a year of fellowship, then 5 years left at a public hospital, income's going to be comparable. It's going to be a little bit less than maybe a private sector or a private practice type role, but you don't have to pay off your student loans at the end of those 5 years. It's only 5 years. Anybody can do anything for 5 years. So would definitely recommend considering that and working with a planner to figure out, okay, what income can I accept that's low enough to balance out having that loan paid off. There is math that we can run behind the scenes on that to see, okay, work with the public sector entity to say, okay, here's the salary that I need that's lower than the private sector, the private practice one offer that I have on the table. I'm willing to work for this, knowing that in the back of your mind that the student loans will be paid off. But studentaid.gov does have some other good resources to put you in the right direction. So this I kind of laugh at this option here because of what interest rates are looking like these days. But if you don't qualify for loan forgiveness and aren't using income-based plans, you might consider refinancing your student loans. This probably, again, doesn't make sense in this interest rate environment. I usually got Bloomberg up on this TV behind me, and just 6 days ago, the Federal Reserve just raised interest rates by another 0.25%. So, average mortgage is the highest it's been in like 3 decades. So, doesn't make sense in the current environment, but if interest rates do come down, which we expect them to start coming down throughout the rest of this year, it could be a good option if we can reduce the student loan or the interest rate so that less is going towards interest, more is going towards principal, less of your money is being shelled out for towards just interest payments. The drawback is are very important with refinancing, because once you refinance it, it's with a private company at that point, whether it's GradFin or whoever else, and you no longer have federal loans. Which means that you could lose some options and advantages that Uncle Sam offers on federal loans, which aren't available with private loans. Things like stopping making payments or deferment, like in COVID, because Uncle Sam just turned off, hey, you don't have to pay your student loans, for X amount of time, well over a year. Even discharging your loans in certain circumstances. So, but again, this I don't think makes sense for 99% of people right now, but I want to at least make you aware that it's technically an option that we can look at. So switching gears here, one of the foundations of a good financial plan is protecting yourself in the event of things hitting the fan. You've all invested a lot of time, energy, and money into your careers, and we need to make sure that you get a fantastic rate of return on that investment. There are 3 major risks that we generally want to get off of your shoulders, and that would be disability, especially if you're a specialized physician or surgeon, death, and then long-term care scenario. That's usually one that we focus on once somebody gets into their 50s. But for protecting your income, this is huge for physicians. 1 out of every 4 employees in the developed world are going to have some type of disability that lasts more than 3 months during their career. Those are stats straight from the Social Security Administration. And but that might not surprise you, being in the medical field. I mean, you often see people at their worst moments. So, whether it's a heart attack or stroke, back problems, cancer, hand tremor, if you're a surgeon, pregnancy complications, or anything else, disability does wreak havoc on a financial plan. And the pay loss that usually comes can affect your personal life, can affect paying the bills, and then also saving for the future. I always say that part of the disability planning picture is making sure that we can keep paying the bills the same way, but also keep saving the same way, because that's going to put you on track keep you on track for your goals. So one of the most common ways to outsource this risk is disability income insurance. I'm sure most of you guys have some level of group disability in place through your employer, maybe a professional association. And that's a great start. However, that's not always enough, and here's why. Most group long-term disability plans pay a percentage of your base salary up to a certain point. Those benefits are usually capped. So if you make above a certain amount, that percentage ends up being lower as a percentage of your overall compensation. So here's an example. This same group plan provides 60% of coverage up to a cap of $10,000. And this is a very typical plan that we see in the market. That means you'd be losing 40% of your income while you're on a claim. And think for a second, how would that impact you financially? Could you keep paying the bills on 60% of your income, getting a 40% haircut? Could you keep saving for retirement, other goals? Would you need to dip into an emergency fund or your other savings accounts, right? How is that going to detract from those future net worth growth? Now, if at the same time you're disabled, let's say you're earning 200 grand, anything over the compensation cap isn't covered. So as a percentage of income, that becomes a smaller and smaller percentage of income being replaced. One other issue is that because your employer is paying for these benefits, the benefits would be taxable income to you if you couldn't work. That means if your employer pays the premium and you have no ownership in the practice, you'll be earning less than the stated 60% number that's normally advertised. So between benefit caps and taxes, you could find yourself facing a significant gap in coverage, especially if you're a highly compensated employee, or if your income comes from overtime or production bonuses, which isn't covered at all with group plans. This is just based off of base salary. So again, group is a great start, but it's not enough. As you can see here, 60% looks good up until that contribution or that income cap. Once you go above that, then we're capped at that $8,000 a month. So that percentage of income being covered diminishes. So unfortunately, choosing the right disability plan to complement what you have through work can be a challenge. And that's because the industry uses confusing terms, conflating terms, and phrases that are not universally applied between different companies. It makes it hard to compare apples to apples in a lot of cases. Most important thing, though, is when you're shopping for an individual disability plan, is how the company defines total and partial disability. Here's why that matters. So let's say that you're a surgeon, and due to a car accident, I'm going to use a live example from one of our physicians. Car accident, can no longer perform surgical duties, surgical procedures. So these duties are your main job duties. This is what defines this, your practice, and really drives most of your billing. So it might be 20% of your time, but it could be 60, 80% of your revenue producing activities. So even if, my client could do their duties with, patient consultation, maybe post-op care, but couldn't do the things that frankly he likes to do, things that he went to a medical school for and fellowship and all the years of school, but couldn't do that. Some policies would define him only as partially disabled, and therefore we get a partial benefit based off of his individual plan. Some policies, though, would consider that person fully disabled, just like you would consider yourself fully disabled if you couldn't perform surgeries when you are a surgeon. Again, other policies would consider that partial because you could still do pre-op evaluations, post-op care. And if that's the case, again, you might have a required return to work or keep working provision to even get a partial benefit. So it's extremely important to know the ins and outs here. We had another client who everything was fine, heart was fine, brain was fine, back was fine. Again, another surgeon, but he had a slight hand tremor that developed. And if you're a patient and going to get your chest cracked open, do you want the guy with the steady hand or the not so steady hand, right? So he was considered totally disabled with us on a $15,000 a month benefit now. So, and the individual plans, by the way, because you're paying for them, the benefit would be tax-free, which is a huge part compared to a group plan. So a couple other things to consider here. The first one, evaluate the entire policy from a 30,000 foot view level. Take into consideration when the benefits start. How long until start of disability to actually receiving cash? What is that time frame? How long do we want the benefits to come in for? Do we want them for a short period of time, like 5-10 years, or do we want them until Social Security normal retirement age? Do we have a cost of living adjustment that we can tack on? Highly recommended for anybody in their 20s and 30s, because if 2022 showed us anything, inflation is a real thing. Second thing, consider the company behind the contract. Back in the 80s, there were 50 different carriers in the individual disability income market. Today, there's only about a dozen. Many of the companies left because they didn't have the financial strength and experience to be successful in the marketplace, basically. There's really no way of knowing when you might need your policy. We don't have any crystal balls up in our home office, but it could be a decade from now. It could be early on in your career. And that means the financial strength of the company that you choose is really important to make sure they stand the test of time. So next thing we'll talk about here briefly is the life insurance side of the equation. In your profession, again, you know how fragile life can be. You might have some life insurance again through work or on your own, maybe again a professional organization, but having the right amount in place and for who and for what purposes is the most important part. How much is really, I like to call it the big four. Those four things in no particular order would be paying off any debt or anticipated debt. If your student loans are co-signed with somebody, that student loan payment will go on to somebody else's shoulders. If they're only on yours, that is the only way to get rid of student loans is if you die. Bankruptcy doesn't get rid of them. They are stuck with you like white on rice. So anyways, the first one of the big four, again, paying off any debt or anticipated debt, replacing income for a certain period of time for a surviving spouse or family, setting up a college fund or some kind of future fund for the kids or anticipated kids. And then the last one would be final expenses, naturally, readjustment fund, that kind of immediate cash needs that the family might need. So, but being detailed with this, I think, is important, right? Once the student loans and mortgage and debt payments are off the picture, what do we need to make sure that life stays the same for the family? If a spouse needs to go continue to work, what kind of childcare, nanny, household help do we might need? So again, being specific, even down to philanthropic legacy goals that you might have. Life insurance can be earmarked for that. But once you have the type, or once you have the number locked in, how much coverage you need, whether it's $1 million, $2 million, $3 million, then you can back into the type. And there's two different types out there. You have term and permanent insurance. Term insurance, I analogize that as renting the apartment. It's really cheap. You get to have it for 10, 20 years, maybe until a certain age. Every year, whenever your policy renews, like the lease on an apartment, your landlord raises the rent on you. But at some point, the lease is up, right? The lease is up, hand the keys over. With a term policy, you just kind of wipe your hands of it. And, thanks for renting the coverage. That's what the insurance company is going to say to you. Permanent life insurance is a lot like owning a house, except for a little bit better tax treatment. So this is actually an asset on your balance sheet that we can save into. Cash grows, tax deferred. We can access the money pre or post retirement on a tax favorable, generally tax-free basis. So pre-retirement for emergencies or opportunities, in retirement for maybe down markets to supplement the investment side of the equation. That's how most of my clients position this if they have it on their balance sheet. Some people use it as an avenue to kind of act as their own bank pre-retirement. So the last thing that we'll touch on here is the long-term care side. Again, I recommend people considering this in their maybe late 40s, early 50s. The cost is just going crazy in this as people are living longer. We're all going to be like Darth Vader at some point, more machine than man. The cost today, you can see this on the different types of care facilities, and then what it'll be like 30 years from now at a 5% inflation rate. And that's what it's roughly been over the past 30 years. So again, offloading this risk, this disability insurance is kind of the sister product to this. That protects your earnings capacity, building up your nest egg pre-retirement. This is protecting your nest egg once you get into retirement. So, if we have a nursing home situation here, we're looking at almost $500,000 per person. So instead of earmarking $1 million for an event that might never ever happen, again, offloading this risk generally makes sense for barring, being in your last name being Musk or Gates. So most people think that a lot of this coverage or a lot of this type of risk is going to be offshore to Medicare or Medicaid, maybe a private health insurance company, but that is not the case. Uncle Sam is trying to get rid of this off of his shoulders. He's looking at the stats, which is 7 out of 10 people in the developed world are going to have something like this happen. And so there are tax incentives to getting this in place, specifically if you are a business owner. You can write off the premiums for taking this risk off your shoulders. It's a completely tax deductible business expense, and the benefits will still be tax free. There are limits on how much premium you can write off given for each state, but that is a huge benefit to kind of optimize this type of plan here. But any initial questions that have come through on the risk management side, Marseille?
Yeah, excuse me. Some of the questions that came in were, how much time does it take to kind of assess how much you need as far as coverage in these kind of insurance plans? I know that this is probably talking about, they're really strapped for time, especially when you're getting into the new career, and scheduling is difficult sometimes.
Yeah. That's a good question. Yeah, and time constraints are an issue a lot of times for people in the medical field. The disability side, the easier answer there is get as much as humanly possible. I know that sounds like a blanket statement, but if you have a delayed earnings capacity and therefore a delayed meaningful savings rate, you're building your balance sheet is delayed. And so your greatest asset on the front end of your career, and really for an extended period of time for most physicians because of that delayed earnings capacity, your largest asset is your future income. And so protecting as much of that as you possibly can is going to ensure that the plan happens without regardless of what life throws at you. On the life insurance side, that can be calculated in 2 minutes. That's very easy to do with a net present value calculator. And then the rest of everything else is generally a cash need. So that's in today's dollars already. We can be as exact, like in our software, we can literally get it down to the dollar, how much life insurance death benefit we need. On the long-term care side, that is a little bit more plan specific because of the options that we have to offload that risk. With the long-term care side, we have usually the standalone option that just covers long-term care. You pay for it your whole life, really as long as you want coverage. And they have options where you can tie it into a life insurance product. So it kind of kills a couple of birds with one stone. That one, we want to generally have the cost of care covered today, and then have some type of inflation amount on the plan. So as far as priorities goes, it would go in the order that I presented it. Disability first, life insurance, then long-term care lastly.
And we got another question in. Can you discuss umbrella insurance?
Umbrella insurance is incredibly important. What that basically does is it's excess liability coverage. So somebody slips and falls in your kitchen, somebody you rear end somebody on the way rushing into the office for to do a surgery or whatever else it is, because you have an MD or a DO after your name, a lot of times you're a target for lawsuits. As soon as somebody finds that out, they're like, oh, they're made of money, let's go after them. So umbrella policies are wildly inexpensive. I think you can get like a $2 million umbrella policy in a lot of cases with your car insurance company for like $50 a month, $600 a year. It's wildly inexpensive, but it basically acts as the catch-all after your homeowner's policy pays out a certain amount or your car insurance policy pays out for a certain amount for a specific need, but it protects your assets from being raided by frivolous lawsuits. Your 401k and permanent life insurance cash values in most states are also creditor protected assets. So my attorneys and physician clients love that. So in the state of Florida here, unlimited liability protection in 401ks and permanent life insurance cash. So I was talking to a client this morning. He's got about $500,000 in life insurance cash value. He gets sued. All the money that's in there that is sheltered from creditors, creditors, debtors, that kind of thing. Declare bankruptcy even, it's completely protected. So that's one big part about the conversation with physicians is liability protection. So umbrella, 401k, maybe permanent insurance, those are great areas to warehouse assets away from creditors and debtors that might be coming after you. So.
Okay, let's keep on going, and then I'll save some of these questions to the end here.
Yeah, absolutely. So switching gears here into the investment side, I'm sure that most people have just thought about retirement as a far off thing, but and maybe you've fantasize about what retirement will look like. What will we spend our time with once we have a bunch of time to spend? But if retirement's on your mind, you're in good company. Northwestern Mutual did a recent study and found that 2/3 of medical professionals, it is their top financial concern. But even though it's a common goal, it can be different depending on what you want to see happen in retirement and what your income demands are, including student loans like we've talked about. So, there's a lot of different places that we can spend money, but we can take out student loans, as you know, for your kids or for a car or a house, but we cannot take out loans for retirement. So incredibly important to save towards. So this gets into the delayed savings capacity that I was talking about earlier, the power of compounding. And we're looking at three different hypothetical investors here, investor A, B, and C. Investor A saves $6,000 a year, $500 a month, and gets just a 6% compounded rate of return over that time period to keep things simple between age 25 and 65. Investor B starts out strong, saves from 25 till age 40, and then just stops, just does whatever and wants to live now or whatever else it might be. Investor C starts at age 40 and then goes until age 65. We see this instant a lot in the medical field starting later on. The person that started initially and kept their way the whole way through, obviously they had the most money at the end, a little over $1 million. The next one, though, was actually the one that started off and then stopped because more money grows on more money, right? Earning interest on interest is the idea there. After that was very lastly, the last person, the person that started at age 40, they still saved 150 grand, which is, $60,000 more than investor B, but they ended up with over $300,000 less than investor B. So again, something sooner is better than larger later. And because most people on this call have a delayed earnings peak years, starting as soon as humanly possible, especially right now when the market is on a 20% decline, we get to buy at a discount, right? The market's on sale. Fantastic time to start saving money from an entry point into the market perspective, so that those dollars again can grow as the market rebounds. So again, long-term savings, incredibly important. So switching gears here to different areas that we can save into. So in terms of how you save your money, every situation is a little bit different depending on the specific goal. That's what we always want to start with in mind first. Short-term goals, those are happen over the next couple of years, maybe a down payment on a house or a new car, checking savings accounts are the vehicles for this. Emergency fund, we also want to keep that in cash, building up to minimum of 3, maximum of 6 months of expenses, not 6 months of income, but 3 to 6 months of expenses from that nice little spending plan we talked about. Midterm goals, this would be a little further out, up to 10 years away. Generally, for these goals, most common is going to be some type of investment portfolio, having stocks and bonds in the portfolio in a meaningful way, maybe a 50-50 portfolio. depending on what the specific goal is. Long-term goals, these are going to be 10, 15 years out, including retirement. So with the long-term goals, there's a lot of options here available to you. The options really open up because Uncle Sam is trying to incentivize people saving for this goal. Remember, for the average American, 40% of their retirement goal is covered by Social Security. Which means that the other 60% is on their source for the average American. If you're in a higher income tax bracket or income bracket, higher lifestyle standard, that 40% is going to be more like 10% compared to the average American. So when choosing where we start to warehouse money, where we save money is important to take into consideration because of the tax treatments. So on a 401k, traditional IRA, 403b, which is the private sector version of a 401k, these are all tax deductible numbers or accounts. So easy math, you make 100 grand, you put 10 grand into a 401k, you're only going to be taxed on 90 grand today, but then the money grows tax-free or tax deferred, which is effectively tax-free. And then in retirement, every single solitary cent that comes out of that is going to be taxable. So you can think of Uncle Sam owning 20, 30% of that account. On a Roth, after tax money goes in, so you save Roth 401k, make 100 grand, put 10 grand into a Roth 401k, money grows tax-free, you can use it tax-free in retirement. So with a Roth, it's kind of like you get to pay taxes on the seed and not have to pay it on the tree, right? For most people on this call, though, the traditional option is probably going to be the best option. That's the one we want to primarily plow money into because you're in a higher tax bracket during your earning years, and then a lot of times drop to a lower lifestyle in retirement or lower taxable income in retirement. So the tax deduction up front is going to make more sense because you're being a lower tax bracket and you pay the taxes on it in retirement. Permanent insurance, again, that's a great asset for long-term safe money. Money in there by law cannot go down in value from year to year, so it's annually vested. And then most companies guarantee it'll grow at a minimum amount a year in and year out. Regular investment accounts, triple taxed. After tax money goes in, taxable during the growth years, dividends, even if you reinvest it, capital gains, all of that, taxable every year. And then it's taxed at long or short-term capital gains when you sell the position in retirement. So knowing where to save money and in what order do we prioritize saving, that's going to be incredibly important. For a lot of our clients that are in residency, the year that they straddle residency and then their full-time income, when they get out of residency in June, July, and they're in their full-time career, that's the lowest tax bracket that they likely will ever be in ever again. So a lot of our clients, if the math makes sense, we'll take the 403b that they're contributing to during residency. They go work, in private practice somewhere, or maybe at a different hospital. Roll that 403b into a traditional IRA, like tax treatment. So there's no, it's not a taxable event. So we have it in the IRA. But because they're in the low tax environment for that year, immediately convert that to a Roth IRA. That 30, 40 grand that we convert will be taxed as ordinary income, but it's going to be at the lowest tax bracket, again, that they will ever be in ever again. Once it's in the Roth side, it's never taxed ever again, forever. Great asset to pass on to the next generation or to use in retirement for yourself to lower your overall tax situation. So a lot of what I'm talking about is the tax situation. We got to win the tax game with the savings here. So, but those are kind of an initial couple of silos that we want to be shifting dollars out to. So because it's such a common goal, let's go a little bit more into saving for retirement. As again, a rule of thumb, we want to have the same lifestyle in retirement as we did beforehand. 20% of income is the general rule of thumb. Given, again, since you've been in training for so long, have a lot of demands on your income for family, student loans, everything else. It can be difficult, but like I said, the 3%, 6%, whatever it is you get from your employer, that counts towards this 20%. So you're really only saving 17% in that scenario. But so again, something sooner is better than larger later, whether it's 50, 100 bucks a month, whatever it is, put something aside even during residency. 401k, 403b, again, these are tax deferred accounts generally. Again, after tax goes in, tax deferred, taxable when it comes out in retirement. We have a limit of 22.5 now, 22,500 that you can put into one of these accounts, with a catch-up contribution also that you can put in additionally on top of that if you're over age 50. Now we can't access these dollars until age 59 and a half without tax penalties. That's the magical Uncle Sam retirement age that that they put in place. The traditional versus Roth IRA world. IRA stands for individual retirement account. If you have access to a 401k, 403b through work, you can't contribute traditional IRA. And if you make over usually around $130,000 a year, you can't contribute to a Roth IRA. So that excludes a lot of people on this call. However, anybody, regardless of income and regardless of what they have available to them through work, can contribute to a non-deductible IRA at $6,500 a year now. That's the new limit after the Secure Act 2.0 back in December. So you can put $6,500 into a traditional IRA and not deduct it, so non-deductible IRA, and then immediately convert it to a Roth IRA. That's what we call a backdoor Roth IRA. And again, if you make $500,000 a year, if you're in the NFL and make $10 million a year, you can do this. So most advisors don't bother with it because it's a logistical and paperwork nightmare. But this is a great way to shovel away extra money. I've got a client that makes $1 million a year. We do this for him, right? So that's a great option. The other option, if you are over 59 and a half and your plan offers a in-service distribution, you can do what's called a mega backdoor Roth. That you can literally put $40,000 into a backdoor Roth if you're in that situation. So also from the Secure Act that passed back in December, if you're in residency, for example, lower income, relative to what you'll be making in the future, you can have your 401k or 403b. You can elect to have the employer contributions be. This is a big adjustment. This has not been the case ever. You'll pay taxes on that this year, but again, you won't have to pay taxes on them ever again. So great option if you have that available to you. All right, switching gears over to the investment side. When you invest, one of the most important decisions you'll make is how to divide up your assets among different asset classes. The two ones that we want to be concerned with primarily are stocks, equities, being a stock owner, an owner of a company, or a bond, which is a fixed income debt instrument against a company. Over almost any 10-year horizon, the U.S. market history, stocks generally outperform bonds to the tune of 2x, in some scenarios 2.5, 3 times what bonds earn. But if the market goes down, bonds hold their value generally, unless it's 2022 when we have a single year spike in inflation. So there's been 4 times when the stocks and bonds have fallen in lockstep, and history doesn't exactly repeat itself, but it definitely rhymes. And each of those times, like last year, was a single year spike in inflation. This determines how risky a portfolio is, how much in stocks versus bonds that we have. A lot of stocks, higher return, but also a lot more risk. And risk, again, is a relative term. This means that the risk is really just the variation in how wide the portfolio swings in value. Shorter term goals, generally we want to have more conservative, more in bonds, fewer dollars in the stock side. But again, that's the main rate relationship between stocks and bonds that we are generally looking at in a portfolio. Let's see here. Time horizon plays into a big factor in this. Again, long-term dollars, 10, 15-year plus, especially 15-year plus money, we want to have something closer to this, because the risk at this point long-term is not a down market. We're going to have down markets over time. You can't avoid them. That's just the reality of investing. But if you're well diversified, then the market will come back. The only way that the market goes to zero is if every employee for every company in, let's say, the S&P 500 leaves their place of employment, crosses their arms, and refuses to work for economic gain. Not likely to happen. So shorter term goals, though, maybe for 8 years out, saving for college education for your kids, we might want to have more in bonds because that's not as volatile. We don't want to take a 20% hit in the market right before little Johnny goes off to FSU. So, but again, we've covered a lot today. Budgeting, student loan management, the risk management side, retirement planning. When you have a plan for all of these different pieces, you'll have a lot more confidence, first of all, with your financial future, but also we can pick up efficiency by having everything play off together and work cohesively within a comprehensive plan, winning the tax game, all that. A few thoughts here as we wrap up regarding planning topics here. First of all, consider working with a financial professional. I would highly recommend it. You have a lot of time constraints on your plate, and frankly, just at the end of the day, not having a lot of energy to deal with a lot of this stuff. So having someone who's specialized and can take this pressure off of you is worth the 1% that you pay them in a management fee, or whatever it is, however they're compensated. So the other thing that I'll point out is customization. Work with an advisor that is customized to physicians. You have unique challenges. We talked about the liability problems a minute ago. You have unique career paths that are different than most people that are working age. So working with someone that knows your unique problems, I think, is important too. And then look for a company that has the financial strength to carry you through your whole career. Those, I think, are the main things to take away here when you're kind of shopping for advisors. And also work with someone that you can work with for a long time. The average age of someone in my career is 57. The average, right? And so a lot of people are going to be retiring out of my career over the next decade. Work with someone that you have a long runway with, that you can work with either for the rest of your life or at least the rest of your career. So any questions that we've had come in additionally, Marche?
Yeah, I have a couple questions here and then we can round things out. I know we are close to the end of our time here. You mentioned creating a habit of saving. Is there an easy way to automate that? Can you talk about that?
Yeah, so a couple ideas there. One, having all of your income auto direct deposited into your savings account, having a written spending plan, whether it's $4,000 a month, $5,000, $10,000, $3,000 a month, and then have that automatically moved into your checking account, and that's what you have for the month. So you're already saving yourself on the front end. Downstream of that, having your investment and your insurance and your planning bills lining up with the dates that you're paid. So if you're paid on the 1st and the 15th, have your advisor draft the things that we need to fund your plan on those dates. So everything that's left over, you can just go buck wild with it. Go to Mexico for a week. Go to Sweden with me for 2 weeks. Go skiing, spoil your kids, whatever. But again, paying yourself first is the most important thing. How you do that, it really just whatever makes sense most to your mind with the ideas that your advisor throws out. I think whatever you gravitate towards, like I said, do that and stick to it. That's the most important thing, is sticking to the plan.
And then you talked about it's important to get started with even just a little bit earlier rather than starting with a bigger amount later. Can you
Yeah.
kind of give a ballpark of like how low, like, can you just get started?
Yeah, for my clients that are in residency, we're putting away couple $100 a month, in a brokerage account. But again, that the habit, 20% of $60,000 of income is a lot less than 20% of $500,000 of income, but it's still 20%, it's still the same percentage. So if we get the percentage upfront taken care of, as income scales, as promotions come, as bonuses come in, we already have the financial fortitude. We already have the habit in place that would know, okay, $100,000 bonus comes in, 30 is going to, Josh for the plan, 30 is going towards student loans, 30 is going towards fun. Basically, that's how I divvy things up for clients for unexpected income, is a third, right? Yeah, like I said, it's you can start out very low with most of some advisors have minimums. I don't for like our residency clients, because I know that again we can grow and scale with them, and they're going to be great clients if we start getting the habits in place early.
All right, well, that's about all the time we have. We're going to go ahead and wrap up here. I want to thank Josh for being here and for our attendees for all of your great participation. I want to thank you so much for your attention. Look to an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, everyone, thank you so much for being here. We hope we will see you at another webinar soon. Goodbye, everyone.
See ya.